What's going on, everyone? I am the Zoomer Value Investor. Welcome to my equity research presentation. Today I want to talk about Tesla. I'm not going to talk so much today about the company or anything like equity research. This is going to be more just about the equity. What are my thoughts on it? Now, one thing I do want to bring up here on the title slide is Tesla. Get out of the old way of thinking if you think they're just like an EV company. When you're talking about Tesla, you're also talking about like a clean energy company, an AI company, AI self-driving company, battery technology company. So yeah, definitely just start thinking about them in a multifaceted kind of sense of way. They're involved in so many different technologies. So we're going to get into them. We're going to talk about their valuation, kind of when I think they're a good time to buy. And if all the tumultuousness in the markets, if that's creating any sort of buying opportunity. So the reason why I really want to talk about Tesla is they've actually had their worst week since March of 2020. Now, March of 2020 is a notorious time in the markets. Go look that up if you're unfamiliar about what was going on back then. It had to do with CV19. And yeah, as you can see here on the left, in March 13 to March 2020, Tesla fell about 22%, whereas in this past week, they fell about 16%. So in a stock like Tesla, that's, hundreds of billions of market cap and valuation nowadays, seeing a fall like that, that's very drastic. So we're going to get into kind of like some things about what's bringing the stock down. So why is Tesla stock crashed right now? Well, Elon Musk is out there tweeting his opinions again. Now, if you're going to own Tesla, this is just going to be a reality that you're just going to have to deal with when you buy into the business. Elon Musk, he's not going to be your traditional CEO. He's going to go saying whatever he thinks on Twitter. He came out and publicly said he has Asperger's syndrome. So, I mean, these are just things you need to consider, that you're not going to have a traditional CEO, for better or for worse. So he's out there, he's tweeting his opinions. I think most recently he's said things about Russia-Ukraine conflict, things of that nature. So anytime that's happening, there's going to be volatility. Again, it's not normal for a CEO to act the way Elon acts. Normally CEOs are much more of a class act, kind of saying things, running things by very close board members or advisors, etc., etc. Elon Musk, he's not going to operate that same way. They also had a deliveries miss of 343,000 versus their estimated 364.4K. So that's a deliveries miss of around 20,000 cars or something like that. You also have to consider Elon Musk. He has to sell Tesla shares for his upcoming 50+ billion purchase of Twitter company. Just remember, Elon has a majority of his wealth is tied up in unrealized gains from Tesla shares. So he's going to have to realize some of those gains to become liquid enough to buy Twitter. Anytime he's selling and realizing those gains, it's creating a lot of downward pressure on the stock. Also, with all the interest rate rise drama, the tech market drama, you've seen how much the QQQ or Nasdaq's gone down. Tesla was kind of due for a price correction that kind of followed in suit with this. It was the same thing like with the Apple stock in the S&P 500. And just at some point, it's such a big part of the broader index and the broader index has fallen so much where it's just really hard to believe that one of the biggest stocks in that index is not going to also come down at some point. So that rule of reality is kind of finally being applied to Tesla. So with all these in our mind, what can we say about our Tesla valuation? Tesla's a really interesting company. They've gone in these last few years from being a cash burn company to a profitable company. Now, if I had to explain this process, it's very complicated, but essentially what it involves was a period of time of many, many, many years, about over a decade plus, where Tesla was just continually burning cash on themselves. They were nothing more than an idea. They burned cash on research, burned cash on prototypes, just continually burning cash and investing in themselves, investing in growth. As you see here, way back in like 2017, for example, we don't even have a price to earnings. We have negative numbers on our price to earnings ratio, as well as very high EBIT margins. It's just very clearly a cash burn company. Doesn't particularly have like free cash flow. So that was Tesla in 2017. Around 2020, after the recent 2019 Model S and other very incredibly successful cars, as you can see here, they switched to being more or less a profitable company. As you can see, things like the negative price to earnings ratio and all that's gone away free cash flow starts turning positive, it became a different company. The thing that incredibly interests me about Tesla is that, as you can see here, they have like a negative price to earnings. Around 2020, they turned profitable, but that price to earnings is around 1,000, or it's 1,111. I mean, that's a huge price to earnings number. Fast forward 2 years to today, they've managed to bring that number down to 85. Now that is incredible. And a lot of that, honestly, was not so much the price change, because Tesla's had a hefty price change ever since 2020. We'll look at the chart here in a moment. But honestly, most of that is from deliveries and actual sales of cars and being a tangible company with a tangible product that's finally starting to make money. So I think that is incredibly interesting about Tesla, and giving them credit where credit's due is this is a company that's gone through dramatic transformation in the last 5 years, although they've been around well beyond these last 5 years. In the last 5 years, they've seen pretty much the entire transition from cash burn to profitability. Now, I'm not saying the valuation is great, more on that later, but gotta give them credit where credit's due. It's a profitable car, clean energy, AI, etc. company. So what the heck is the stock? Looking at this chart, I mean, just looking at this, like, what the heck is happening here? As you can see here, nothing really was changing too much in the stock from 2014 to before 2020. Now, a lot of that reason had to do with it was a cash burn company. You know, sometimes it's really hard to like catalyze a cash burn company because their valuation metrics are going to be very unattractive to a lot of investors. As I was saying, you know, at the spark of 2020, it still did not have attractive valuation metrics by any means. Not that it even has them today. Like, there's nothing too particularly attractive about price to earnings of 85, close to 100. But one of the things that really did catalyze this growth in 2020, you see this spike here. A lot of this was the Model S here. And then, you know, seeing the company turn into profitability, that put a lot of investor confidence behind it, and it just shot the stock up. As well as other things like 2020, interest rates were set very low at that time, make tech appear incredibly valuable. But you also have here, I mean, just look at these changes in year-over-year revenue: 82.5%, 14.5%, 28.3%, 70.7%. Compounded from these last 4 years, that's about 49-50% compounded annual revenue growth. And when you have things like this really plays into the valuations of the stock and sends them to the moon, sends them up, creates reason for the stock to have alpha and reason to go up. But that's the thing, though, you know, is like this is a stock that when it does go up, it goes up under a lot of growth assumption. It doesn't grow up so much under that it's trading at a deep value and it needs to realize that value. It's not going up so much because of value discovery. It's going up a lot because of investor excitement about the stock, investor optimism about the stock. Remember, price to earnings also shows investor optimism. Now, that's a bad thing for us value investors. We don't like to buy into things that have a ton of optimism priced in, because that just that means if anything goes wrong, it's going to be a longer way down. But investors are optimistic about that field, and you're going to just really be harder pressed to buy into that field because of all the optimisms that investors might have there. For example, look at cloud computing. You're going to have a hard time finding anything trading at a stark value in the cloud computing sector. You look at almost any company, be it Amazon, Salesforce, Snowflake, any company really that has very significant business in that sector, it's not going to be too appealing to like a fundamentalist value investor, because a lot of those valuation metrics are going to be stretched because there's a lot of optimism about the compounded annual growth rates and potential in the cloud markets. It's the same thing applicable to Tesla and a lot of the EV companies. There's so much investor optimism in here that if you even want to play this industry at all, you're going to really have to shop around that optimism, and you're going to have to really make sure that you're putting all that, you know, valuation metric, all that investor optimism just into your model, and you're taking account for it. Because as I said, anytime anything goes wrong, all that investor optimism, it can go out the window, and all that's going to price into the stock, and it's going to create a long way down. So yeah, just again, looking at this, you know, one of the reasons why Tesla is able to shoot up so high ever since 2019 to now is because of these growth rates. And it is more or less priced into the stock, and that's something you should absolutely be aware of. Now, this is the really interesting thing about Tesla is although it's such at a high, lofty valuation, it's becoming more and more clear as the days go on. It is a company that is going to go nowhere. It's going nowhere. It seems like it's going to be here for a good amount of time going forward. They have fantastic cars. This is more or less undeniable. You've seen this now with after S&P upgraded their credit score. So now Tesla is 2 ratings above junk bonds, and it is 1 rating away from being considered an officially blue chip stock. So that's why I think it's so interesting about Tesla. It's at this weird cusp now because they become a profitable company finally. And they are making the valuation better by actually selling their product more and things of that nature. It's becoming really interesting because I feel like it still very much is in that realm of like moon boys, Wall Street bets, like, oh, all in on Tesla, like we love this company. Like that kind of like culty kind of like nature behind it is still there with the company. But I'm also really starting to see it treated more and more like a blue chip stock, blue chip company where people like it or hate it, it's just going to be a stock on the stock market for the foreseeable decades plus, and it's not really going anywhere. Over here at the left, we got the 2019 Model S, huge car in their company history, did a lot of things for them. And then at the right here, we got the future of Tesla, the Tesla Cybertruck. Beautiful, badass car. I highly recommend you look into it if you haven't already. It's definitely on my list of something I'd like to have very soon in my life. I'd like to be hopping out of the Tesla truck in the next 5 years or so. I really hope that it just ends up being everything it's promised to be, because when I look at a car like that in this design, it just looks to me like it really is the future. I mean, its design, I don't know if you actually know this, but its design was modeled in part after cars like the Back to the Future vehicles or the cars you see in the Blade Runner series. So fundamentalist value investors really need to be aware of companies like Tesla. And I say beware because, number one, do not short companies like this because they can easily blow up in your face. And that's what happened to a lot of well-esteemed, famous Wall Street type investors. Look up Jim Chanos, Tesla short. Look up Mark Spiegel, Tesla short. Look up all these people. They've lost a lot of money shorting Tesla, and Mark Spiegel especially. And, it's just when you are short a company with like a majority of your portfolio, and that company, like, as you can see here, Tesla like 28x'd around the 2020 time. If you're short that company, your losses are almost infinite. As long as that stock keeps going up, you're short. Like, there's no telling how much money you could become in debt because of your bad short position. Now, whereas if you're just net long things, you could lose 100% of your money, but isn't that better that you just lost all 100% of your money on a trade that you risk allocated well to, versus a trade where you were thinking you were going to make like double your money, but actually you lost like 30-fold your money. You're like 30-fold in debt. It's like night and day difference. So that's why I think you need to really be aware that this is not a stock that I would go out there and short. I would be very, very cognizant of that. I would stop loss. I would be very, very careful with something like this, because with tech and innovation, things of that nature, there's a lot of disinflationary upside. You never know when it could come. You never know when you're wrong. The other thing, and this is more to just value investing formula, especially like fundamentalist type value investors, ones like Aswath. Aswath warns about these a lot. He has lectures. He's a professor at the University of Columbia on value investing. He talks a lot about how value investing has become like this finger wagging practice. It's kind of almost lost its way in the new time that we're in. And that's because of stocks like Tesla exist, because unfortunately at no point over here prior to its takeoff in 2020, at absolutely no point was Tesla a buy on your standard discounting flow cash flow model. This was always kind of like a growth company, kind of like investors who bought Tesla were buying a story knowing that this was a growing company, knowing that they were going to make a great car at some point. They just didn't know when, and eventually it did happen for them. But the thing I'm just really warning value investors, especially fundamentalist value investors, that at no point was this company a buy to you. Yet this has been one of the best performing stocks of the past couple years, so you've left all those gains on the table. The phrase that's different this time often gets thrown around in the stock market, talking about, it's often said mockingly about how people get greedy in their positions and things of that nature. But in Morgan's Housel's Psychology of Money, she has a chapter where she talks about how truly unpredictable the economy is. And she talks about how, because of that nature of the unpredictability of it, you can't really delegitimize people saying it's different this time, because sometimes it actually is different this time. And Tesla is one of those few stocks where it truly was different. Like there wasn't any stock like this. So that's why I'm saying it's just fundamentalist value investors have to really be careful, especially in the new age, because I think they've gotten to this point where they're becoming too much of these finger wagging entities, and they're really getting blown up and leaving a lot of gains on the table because they're never ever getting involved in a stock like Tesla that's created. Literally, this is a stock that created a career out of a person like Cathie Wood. Like, you never heard of Cathie Wood if it weren't for Tesla. So, I mean, this stock is like make or breaking careers, and it's just really important that we as value investors just take this for what it is, and we don't become fundamentalist and flawed in our thinking. So to even somewhat start to take Tesla seriously, what I would do is I would use Peter Lynch formulas that better account for company growth. So ordinarily, you definitely would factor in your dividends into these types of calculations, but because we are talking about Tesla, which is like a non-dividend yielding company, they don't have any structured dividends. Tesla's just using the cash for other things. It's important to remember that a company can only do so many things with the cash that they make. They can pay back the debt, they can invest it, they can provide it as a dividend for shareholders, but they do not have to. They can buy back the stock with it. They can do any slew of these things. Tesla, they just do not choose to use a dividend, so we are not calculating the dividend in our calculation, but what we will be using is the PE ratio as well as our earnings growth projections. It's a very easy calculation. As you can see, a company that goes 20% a year and trades at 20x earnings would earn a Peter Lynch fair value of 1, which would mean that it is at a fairly valued price, and Peter Lynch would be prioritizing a company like that. That is 1 or below. So here's where the issue I have with Tesla at the current prices today. For a PE of 85, Tesla with no dividends, it would need to grow 85% more or less to be at fair value. And over the last 4 years, it had a 49% compounded annual growth rate in its revenue. And the other thing I will say is, for a company that has been on an upward trajectory and is selling more and more of its product, becoming more and more popular, a slowdown is just inevitably going to happen for all companies that are scaling up massively. So that's the problem I have with Tesla, more or less at today's price. I don't think it's bad to take a nibble out of the company. Like I said, it's, becoming more and more S&P investment grade. If you really do believe in the company at around this price point of around $200, I think it is not a bad company to nibble, but you have to understand that you are buying an overvalued asset. I think it is really important as value investors, we sit down, we think about this, and we go, this stock is pricing in 85% growth with its high-flying, lofty valuation of a PE of 85. Do we think that's realistic? I'm not going to lie, y'all. I think that's a little lofty, and I'm very cautious when it comes to buying Tesla. It's a company maybe I'd take a nibble out of for some fun, with some fun money, but I would not make it a serious position in my portfolio, at least at this valuation, but that's just me. Now let's talk about some scenarios here, shall we? Let's say Tesla stock went to $100, drastic price change, I know, but let's just say it continues its downward trajectory. But let's say that there's no significant news also. So the stock goes down, but no real news came out. We're still just talking about the same stuff, like Elon Musk tweeting. We're talking about the things like, they missed their deliveries by a couple thousand cars. Well, that's not super significant news to me. What I think would be more significant news would something be like a competitor came out with a battery technology that just is night and day better, and all experts are agreeing like, we don't know how, but this is a better battery. Well, that would challenge the Tesla's moat greatly. Or something came out about, a fire at a Tesla factory, or like huge news that just would dramatically change the course of the story. Well, I'm not so convinced that anything like that's shown up yet. So if I watch the price of the stock go from $200 to $100 and that's still intact, that nothing's changed about the story, the valuation is going to change and my interest is going to change greatly. So if Tesla stock went to $100, the price of earnings then would be around $40. And if we are assuming around 40% growth, then in that case, which I do think is more realistic because of what I have seen in the last 4 years, what is projected, etc., is that more realistic than 80%? Absolutely. In that scenario, then you have Peter Lynch fair price of 1, and Tesla is a buy now. So I'm looking more for closer to $100 to load up on the stock. Around $200, I'm not so much interested. So yeah, like I said, this is just a really, really weird company. Again, like, I think you do not want to short this. If anything, just do not buy this. Do not short this. Just watch this. It's just a really, really weird stock because, I mean, take a look at this here. Analysts are very bullish on Tesla still, even with all the high lofty valuations, all the growth that is kind of like inherently priced into the stock. But as you can see here, you have analysts saying things like, oh, we expect like 38% quarterly growth. We expect like, 81% annualized growth. Like, there's a lot of high flying analyst forecasts on this growth, but then again, just think about what is realistic. Like, as value investors, let's be conservative. I do believe that a lot of that growth and company success is priced into that stock at current prices. And I would be watching for, having something more like a week in this past week Tesla saw, like more downward pressure on the stock, bring it maybe to a more reasonable valuation. And it just really is a hallmark of value investing discipline that we don't really buy good businesses until there is some kind of margin of safety present. And when I look at Tesla, I kind of see this more as like a fair value kind of business. I don't really see this as a margin of safety type of buy. I see this as like all the loftiest type of growth rates are priced into the stock, and the stock's at 80 plus PE, and just a lot of that company success, a lot of that technology, that narrow moat they kind of have in tech, and potential disinflationary upside in tech they got. Just a lot of that seems priced into me right now. So Tesla's just not super attractive to me compared to other offers in the market. I think one example I really want to throw out there is the semiconductor / chip designer, Advanced Micro Devices, AMD. So when we take a look at AMD's metrics, their price to earnings, their valuation, their analyst growth rates, we apply that same Peter Lynch formula, we're going to get a lot more of an attractive outcome. So as you can see here on the left, for earnings per share, average analyst estimates out of about 36 analysts are saying around 40% growth annualized for AMD. Doesn't seem crazy to these analysts. So let's say we do have our 25.7 PE on the company, which, I will note that's a lot lower than the 85 we've seen in Tesla. We're assuming a 40% growth. Well, our Peter Lynch fair price ratio is 0.6425. That's a lot lower than 1. This is very much at the Peter Lynch fair price with a margin of safety. But the other thing I will note is that on more discounted cash flow models, value investors will look at AMD and scoff. They'll see the price of earnings higher than the S&P 500. The S&P 500 price of earnings currently around 18. They'll see the 25.7 PE on AMD and they will scoff. They won't want to be a part of it. They'll want to buy the stock closer to something like $30 or something of that nature, which I would too, but is it going to get that low when the market is pricing in 40% growth rate? Maybe not, So again, I don't really own either one of these businesses. I am more interested in accumulating AMD though, if I had to pick between the two today. Number one, buying tech can be very difficult because a lot of these high growths will be priced into the stock. Tesla's a company that was at one point above $1 trillion. Like, I believe pre-split was like $1,200 a share at one point. AMD's a business that was at one point $170 stock, and now it's like a $50, $60 stock. So what I'm trying to say is it could be really hard to buy into these really nice tech businesses that have a really great growth projection, have a really great product, a really great company. I don't think you want to avoid these businesses entirely. I just think you want to be very, very, very cautious, and you want to know what you're buying. You want to risk allocate very well, and you want to try really, really hard to not overpay for growth. And you want to do that by using things like the Peter Lynch formula, like a discounted cash flow model, and you want to use things like conservative estimates. But I don't think that means that you should subscribe solely to one trade. I think you should amass all these things, lay them out on the table, pros and cons list, and then start making decisions for yourself. So here are my final thoughts on the Tesla valuation. With a lot of the company future success priced into the valuation, I would prefer other deals right now. I will say though, if you really do believe in the company for the long term, you have a very long outlook, I do think it might be worth nibbling some ownership in a very, very, very small allocation. Around $200 a share. Something I will note is that Morningstar, I think they do a great job with all their analysts and all their valuation. They are giving Tesla a narrow moat They do believe that the fair value estimation is $250, so they believe that the shares are slightly undervalued at this current time. Ideally, I want to purchase Tesla stock a lot closer to $100 a share on a price drop. If no news changes, if nothing significant changes about the business, I can buy the same business for about half the valuation. I'm going to really start to pour some of my personal capital into that business at something like that happens. Because around there, I can point to the business, say like, oh, great technology, narrow moat, tech business, fantastic products. I love their business. And they're trading at Peter Lynch fair price. So yeah, I'm gonna go ahead and take a bite out of them. Now, Tesla will not be in value investment territory unless something like $50 a share shows, and it would have to be on no news change. As I said before, I don't want to buy a business where the fundamentals have significantly changed for the worse. $50 a share would put Tesla around a 20 PE. And in combination with something like a 50 to 80% growth rate being intact, I mean, this would absolutely be a deep value business at that price. Around $50 a share, that's where I might consider something like making Tesla like a core holding. Like I would buy a lot of shares of it if no news change and the company got that low, because I do think it is a fantastic company. So again, just backtracking, around $200, like no news changes, nothing like huge happens. This is all, again, just very isolated to the company, like no huge market fluctuation, no significant news changes, all just Tesla news. Around 200, I believe that the stock is a nibble. Around 100, I think it's a buy for a very small to decent sized allocation in your portfolio. Around $50 a share, I believe it becomes closer to deep value. And again, everything is on no news change, no fundamentals change. Thank you guys so much for watching my video. I hope you really enjoyed it. I am the Zoomer Value Investor. I'm going to be doing a lot more equity research like this. I'm going to be talking about stocks, ETFs, all types of things happening in the market. Please leave a like, subscribe if you enjoyed. I will be right back at you guys with more videos later. Peace.